Okay, well, I'd like to officially welcome everyone. This is the first for us doing webinar via Zoom, so world has changed, but we figured if we can't bring the analysis physically to you, we'll do this remotely. So this will be the first one, and if it's a success, we will look to do more of these going forward. And just for everyone, I mentioned before, we are recording this, so we should be able to put this up on the website afterwards. So I'd like to welcome everyone to Shaw and Partners. This is our boardroom that you can see, and Martin Crabb, who is our Chief Investment Officer, that will be giving us his insights. And this is in conjunction as well with the Warringah Chamber of Commerce. So Matt Tanks, you can see, Vice President. Might just throw over to you for a sec, Matt.
Yeah, sure. All I wanted to say, guys, was thank you so much. For those of you on the line, Shaw and Partners are a great sponsor of the Chamber. They've signed up with us for 3 years, so really made a commitment, and we're just really glad to have them on board. And thank you guys for taking time out to do stuff like this for the Chamber. Appreciate it.
Thanks, Matt. And just a quick overview. Markets have obviously been extremely volatile the last 6 weeks. So what we're going to seek to do, and we're going to run this, Mark will speak for 15 or 20 minutes, and then we'll open it up for some questions. I've already got a few of your pre-sent questions that we will seek to answer. But essentially, we're going to try and go through where are we now, where have we come from, and where are we going, I think is probably the most important one people want to try and get out of this. So with that, I'll throw it over to Martin and just try and follow the presentation, and we will go through some questions at the end.
Thanks, Jonathan, and thanks everyone for taking some time out of your day to join us on this web call today. So, as Jonathan said, we're just going to spend about 15 or so minutes just running through, and there's lots to talk about, obviously, just running through the high points of what's been happening in markets, how we see things panning out, and what you should do as an investor with your portfolio. So I'm going to talk about the coronavirus and talk about the market, talk about the economic impacts, and hopefully that'll give us a little bit of a roadmap as to what to do with our money. And then if we've got some time and you've got some questions at the end, we can get stuck into those. So I might just sort of kick off with this presentation. Hopefully you can all see this on your screen. Depending on your configuration, you might be able to see myself and Jonathan. You might be able to see the slides. Hopefully you should be able to see both. So firstly, general advice disclaimer. I'm not giving you personal advice here. I'm just talking in general, and you cannot sue me if any of my predictions prove to be incorrect, which possibly they might be. So I just need to get that out of the way. So in terms of the virus itself, I spend a couple of hours every day updating my spreadsheets with all the latest data from all the major economies around the world, and I've just been tracking this daily growth number. I look at the virus ex China and Korea, because those two countries obviously had an outbreak earlier, controlled the outbreak. Really important to look outside of China and Korea on these numbers. So what we've done here is look at the world, just the daily growth rate in the virus since it sort of started appearing in early January. There's a bit of a spike there when Wuhan province decided to count a lot more cases, and you see that sort of spike there. But just smoothing that out, the daily growth rate for the virus sort of went to almost zero in mid-February, and that's incidentally when the share market peaked. The Aussie share market peaked on the 20th of February, because the view then, as you can see, was this virus is under control. It's not really spreading outside of China. Let's not worry about it too much. Not long after that, it was apparent that that wasn't the case, and that based on we're such a global village and we travel so much and we deal so much with each other, this thing was never going to be contained within China. So as those cases started to grow, the markets really started to sell off quite dramatically. You can see that the line starting to rise from sort of mid-Feb to mid-March, and incidentally, it sort of topped out on around about the 23rd, 24th of March. Again, incidentally, the 23rd of March was the bottom of the share market in Australia. So we had a peak on the 20th and a trough on the 23rd, and I'll talk a little bit about that later. But importantly, the trend has been down since then. So this is looking at infections, and obviously the number of infections continues to grow It's about 2.5 million. It'll reach 3 million on the weekend, but it's growing at a much slower pace, which is reflective of the social distancing that's happening. So what I'm focusing on now is less on growth in new infections, but more importantly, the change in active cases. So these are people that have caught the virus and haven't recovered or haven't passed away. So different countries have different mortality rates depending on a whole bunch of things, including the age of their population, the quality of their healthcare, how early in the treatment are they being diagnosed, et cetera, et cetera. So different countries have much different mortality rates and also recovery rates, again, depending on the age of the population, the quality of healthcare, how soon we're testing people, et cetera. But on a global basis, you can see the numbers jump around. France, for example, weren't including people who were infected in aged care facilities. They decided to include them. The numbers jumped by 20,000 in one day. So there's all these sort of different measurement issues, which are very frustrating, but and they result in these sort of volatility in these numbers. But really, you've got to look through the trend, and you can see there that the number of active cases is starting to fall. New active cases is starting to fall, which is very encouraging. So modelling it out, what it looks like. So this is new cases, which is that sort of turquoisey blue line on the right-hand axis. The left-hand axis is a estimated distribution of the virus. So it's following, for those mathematicians, a cumulative log normal distribution. So that's the fitted curve, which is that dotted line. So we just derive that mathematically based on what we're seeing. And the red line is actually the cases that we're seeing. So you can see that it seems to be following that curve pretty closely. And that does predict a levelling out, what everyone calls a bending of the curve or a flattening of the curve. And we should see new cases start to fall away, which is really encouraging. And that's allowing governments to start having conversations about reducing the lockdown and starting to get back to work. So everyone's obviously dipping a toe in the water. You know, we can send our kids back to school for 1 day a week. Not sure how helpful that is. You're still got to look after them for the other 4. But I think there's a range of countries in Europe, Germany, Austria, Czech Republic, Croatia, Denmark, are all looking at relaxing their lockdowns and getting their economy open. And you know that Donald Trump is as keen as mustard, very technical term, to get the economy going. One reason possibly is that his business empire would be getting absolutely smashed by this. He owns casinos and resorts, and he has a lot of debt. And one industry you don't want to be in right now is the casino and resorts industry with a lot of debt. So he may have greater motivation than a lot of other politicians to get the economy open. Most politicians will be listening to their health officials. And, you know, you watch TV every night. The health officials are very wary about relaxing the social distancing because they're worried about that curve starting to head back up. That would be a disaster, both politically and also for the health system if we were to have an outbreak of cases. There's one country where that happened, or 2 countries where that happened. One is Singapore. So Singapore thought they had it nailed. They relaxed some of the lockdowns and the virus took off again. And Iran is another country where they thought they had it nailed and it took off again. So everyone's very worried about that. So it'll probably mean that we're locked down for longer than these charts suggest that we should be. But just something to be aware of. So, you know, from a virus perspective, if there was just about the virus, you'd be buying stocks because it does seem from this analysis that we're through the worst. But it's not just about the virus as some of these charts will show. So I just want to look at the market now. So just looking at the S&P ASX 200 index, which is probably the most broadly looked at index. As I mentioned earlier, the 20th of February and the 23rd of March. Now write those dates down. You'll be talking about those dates for a long time. So the 20th of February was the peak of denial in the Western world about the virus. The fact that we thought it had been controlled, it was just a Chinese phenomenon. And that's when the market peaked. And our market peaked at 71.62, as you can see. And then the 23rd of March, also write that date down. That was the date of great capitulation where people panicked. And, you know, unfortunately, some people sold all of their stocks on the 23rd of March and, you know, they're probably not too feeling good about that. That was the date that the Fed launched its bazooka. So the US Federal Reserve announced that it would be pretty much backstopping the markets. Not only did they cut rates to zero, they'd sort of guarantee that rates would stay there for a long period of time. They also put 1.5 trillion US dollars, which is our entire GDP, by the way, into the market in 5 days. So in 5 days, they pumped the equivalent of the Australian economy into the money markets and said that they pretty much had unlimited ability to continue to buy treasuries and take people's money. So that was a huge shot of confidence to the market. And also around about the same time, we saw fiscal stimulus. So we had governments stepping in with a range of measures to try and cushion the blow. So a lot of the analogy we use in the market is about the bridge. They're trying to create a bridge across the recession. That didn't happen in the GFC really until much later in the game. This time it's happened from both the central banks and also the government. So to put the central bank thing into context, it's about 5.5 trillion US dollars that's been put aside by central banks around the world to try and help the banking system, financial system cope with the stress. And it's probably multiples of that in terms of fiscal stimulus. So obviously Australia leading the charge there with its fiscal stimulus. So that's sort of caused the market to bounce. It's having a little bit of a wobble the last couple of days, but certainly we had a pretty strong bounce off those lows. Just in terms of earnings though, arguably earnings aren't important in this market because a lot of companies don't have any earnings or don't have any revenue. So if you think about a restaurant or a cafeteria, they're closed. All the restaurants in this building are all closed except for one or two that are serving coffee. So they've got no revenue, they've got no earnings. How do you value a business with no earnings? It's kind of tricky. So a lot of companies in the market are going through a period of very, very low earnings. And we've started to see, again, quite belatedly, analysts start to cut earnings forecasts for earnings for the next 12 months. They've only really cut them about 17.5% so far. Now, this is obviously changing every day as companies come out with statements about their profitability. We had a couple more today talking about, how the virus has impacted their business or the shutdowns impacted their business. But the 17.5% reduction in earnings is not as significant as the fall in the market. So the flip side to that is how much are investors paying for those earnings? So again, just looking at the peak and the trough, on the 20th of February, the market was happy to pay around about 18.5 times earnings for companies. And you can see that PE ratio, so the price you pay for a year's earnings, have been trending up from a low in late 2018 of around about 14 times to a peak of 18.5. Subsequent to the sell-off, that PE ratio fell all the way down to 12. Now that 12 is the lowest it's been for probably since the GFC. So they represent the two ends of the spectrum, if you like, the extreme optimism on one front and the extreme pessimism. The PE ratio of the market's actually trended back up to around about 16 times. So on an earnings basis, the market by no means looks cheap. In fact, it's starting to look a little bit on the expensive side. So this is what we call a bear market rally. It's clear to us that earnings will continue to decline. Share prices probably won't decline as far as earnings do, but the bounce that we've had is probably a bit too fast based on that analysis. So the market's paying 50% more in PE terms than it was just a little bit over a month ago. So a bit too fast. So just looking at historically what happens in slowdowns, and look, this is probably more like the Great Depression in terms of the economic numbers than the GFC or even the 87 crash. I was unfortunate to live through both of those as an investor. The 87 crash was quick. The recession that followed it lasted for 4 years. It was terrible. There was massive unemployment. There was lots of loss of income and so forth. The GFC was a pretty bad one as well. Again, that was about 18 months in duration. This looks like it's going to be 6 months. So it's going to be quite different to these other drawdowns. But just in terms of this chart here on page 9, shows how far analysts have cut their earnings estimates for companies in a downturn. And you can see that we've started to accelerate. But, during the GFC, analysts cut their earnings forecast for the market by over 40%. And arguably this downturn is going to be deeper than that one. It does look like unemployment is going to go over 10%, despite what Governor Lowe said yesterday. And we could lose up to a quarter of our GDP in 1 quarter. Certainly analysts around the world and economists around the world are talking between a 25% and 40% decline in GDP in different countries. So I think the UK, the current forecast there is for a 40% fall in their economy in the second quarter. So we're going to see a very dramatic reduction in profitability of companies, and we're going to see, you know, those earnings projections continue to come down. So the question is, do you worry about the troubled water? So any Simon and Garfunkel fans, the bridge over troubled water, do you worry about the troubled water, or do you focus on the bridge? I think the market's sort of waxing and waning between those two things. So I think, you know, to be honest, I think if you look back on, you know, investment purchases that you make in the second quarter of 2020, if you look back in a number of years, it's probably going to look like a good decision, but it may look like a terrible decision over the next weeks and months. If the lockdown is longer than people are forecasting and the economic damage is worse than people are forecasting, then obviously prices for everything can go substantially lower than they are today. But having said that, in 2 or 3 years' time, as I said, assuming some return to normality, the prices you pay now are going to look great. And that's the big dilemma that everyone's focusing on right now is, you know, are we at the bottom? Is it time to buy? Did I miss the bottom? All that sort of stuff. And I think that's, we'll talk about that later. That's probably a little bit of a dangerous way to approach it. So I just want to talk to some of the other risks that are out in the marketplace at the moment, and this concept of negative feedback loops. So what is a negative feedback loop? Well, probably a simple way to think about it is if you're a landlord, for example, and you rent out your flat, and the person who rents the flat from you has lost their job due to the COVID-19 shutdown, they're probably going to come to you and say, look, I can't make the rent payments this month. Can you, can you give me a month off, or can I pay you back next year or whatever? And you go, okay, I probably should do that. But you've got a bank who wants their interest payment. So you have to go to the bank and say, well, we can't get your interest, or you may have a builder that you owe money on for the property or maintenance or whatever. So you can't pay them. So they then can't pay somebody else. So you see that one person's problem actually cascades through the economy, and we're starting to see that happen, more broadly. So there's obviously around about 1 million people have either been stood down or had their hours reduced. Centrelink has been swamped by people applying. They all have bills to pay. Those people who are receiving those bills are going to struggle. So it's going to feed back through the economy, and we're starting to see that. There's also this feedback loop in terms of liquidity. So one of the things the government introduced was the ability to access your super if you're in financial stress, up to 10 grand this financial year, and then 10 grand next financial year. So pretty much anywhere between here and the 30th of June, you can get 10 grand out of your super. And then as of the 1st of July, you can get another 10 grand. So that's required a lot of industry funds to go, well, okay, we need to raise liquidity. We need to have that cash available for those people who are going to take the money out. Now, what a lot of these industry funds, it's not just industry funds, it's other long-term investors like the Future Fund, have loved these illiquid investments. They love owning, an airport or a toll road or a forest or a farm or whatever, where you don't mark the value of the investment to market on a regular basis. So it doesn't look like it's risky. The value doesn't move much from year to year. If it's an office building, you might get a value around every year or two, says, yeah, it's worth what you paid for it and a bit more, and that continues to go on. So you look like you get this nice, smooth investment return, whereas if you're in the listed markets, as we know, they jump around all over the place. We're all of us are bipolar, and we panic in and panic out, and we move the prices all over the place, so they look really risky. So all these industry funds have gone, I don't want to be in those liquid, risky markets. I want to be in the unlisted, unrisky markets, and it'll make my returns look fantastic. So the poster child of this is Host Plus Super. So the CIO there, Sam Cilia, is in the paper quite a lot. He's being attacked by the Financial Review. It's actually quite entertaining. But they've got 25% of their fund locked up in things they can't sell. So again, it's one of these negative feedback loops. As they're in this thing called the ISPT, the Industry Super Property Trust. It's a $10 billion fund. It invests in buildings in Australia, and you know, they can't just sell those buildings. It's very difficult to create liquidity out of that market. So, you know, Hostplus need to take their money out. What happens to that fund? Does it freeze? Does it sell a really good building and give all the money to Hostplus? What do the other people in the fund think about? So what typically happens is that these things freeze and they gate. So the fund says, look, you can't all have your money tomorrow. I can't sell $10 billion worth of real estate in this market, but I will sell some properties, and then I'll give you all a chance to get your money. Now, that's probably fine for the industry super funds. Most of the people are going to leave their money in there, but it's not fine for an individual investor. And the reason for that is you don't have 100% certainty on your liabilities. You don't know when you need the money. You don't know when you need access to your portfolio. You don't know what's in your portfolio. So that sort of illiquidity, we always counsel people against it. We advise people, even though it looks attractive to put your money into an unlisted fund or a private equity fund where you can't get your money for 5 years, liquidity is really, really important. And even if it costs you a bit more in return to have access to that liquidity, it's really critical that you have it. So the other thing is just in terms of transparency. So do you know what's in? If you're in a fund or an exchange traded fund or a managed fund, do you actually know what's in that? We've had a really good example of that in the past 24 hours with the oil market in the US. So it's all over the news at the moment. But there's an exchange traded fund, an ETF called US Oil. USO is the code. It's listed on the New York Stock Exchange, and it's supposedly giving you access to oil prices. So if you're like a lot of us and you think these low oil prices are unsustainable, I'm going to go and buy oil, I'm going to sit on it for a couple of years, and I'm going to make a ton of money, and you go and buy this ETF, you're not actually getting oil. What you're getting is a futures contract to take delivery of oil at some point in the future. Now, what they've been doing is buying short-dated contracts, but they can't physically take delivery of the oil. So when the contract is close to expiry, they go, pardon my French, shit, what am I going to do with this oil? I can't take delivery. I've got nowhere to store it. Oh my God, I better dump this contract. So that's what happened in the past 48 hours. These ETFs that own 25% of the futures contracts had to sell them. There were no buyers, so they had to give them away for minus $40 a barrel. So that's what you're getting in that US oil ETF. There's an ETF in Australia that's quite similar. People think they're buying the oil price. They're actually not. They're buying a futures contract which can trade below zero. So it's really, really important that you know exactly what you own, what's in your portfolio. You've got liquidity and transparency. So that's really, really important. So in terms of investment strategy, and I'll just talk a little bit about what we do here for our clients in the separately managed account business, is there is I suppose a heightened degree of uncertainty at the moment. I mean, I have my crystal ball. I do all my modelling. I think I can work out when the coronavirus is going to peak. And I'm going to try and use my political nous. My father was a politician. My father-in-law is a politician. So I know politics really well. I know how they think. I'm going to use that, try and predict when economies are going to open. I'm then going to use my economic training. I studied economics at uni. So I'm perfectly placed to work out what to do, but I don't have the confidence in my forecast to be able to be definitive right now. And I think people that do think they have the confidence in their forecast to be definitive are probably kidding themselves. There is so much uncertainty around this, around how it's going to play out, what's going to happen with the third world. So places like India, Kinshasa in Nigeria, Sao Paulo in Brazil, massive cities, massively dense populations. If the virus gets out there, they can't social distancing. It's not possible. What the hell are they going to do? So there's a lot of uncertainty around that. There's a lot of uncertainty about what governments do. There's a lot of uncertainty about whether these policies that are in place are actually get money to the people who need them. We've had Virgin collapse. What other businesses are going to collapse? So there's a lot of uncertainty. So what do you do in times of uncertainty? You've got one of two options. One is to go to cash and just, at least you're not going to lose money. The second one is to have a long-term investment policy and stick to that. The reason that we develop long-term investment policies for clients is because we don't know what the future holds. What we can say is, look, let's look at 100 years of data or more if you can get it and work out a policy that's going to deliver the return that you need over a very long period of time. And then let's make sure we use that as our roadmap and we don't veer too far away from it. So I'm just going to show you some portfolios here that we run. So we've designed these portfolios after a lot of modelling, and we think this is a bit of a value add. We've looked at portfolios from an Australian perspective. So we take into account things like franking credits and capital gains tax and these sorts of things, which even super funds have to pay. And so we've built these portfolios that we are confident will return the objectives that we've set for them over the longer term. So in the short term, anything can happen, but over the long term, we think these returns are quite feasible. So you can see there the income portfolio, 3% above the Reserve Bank cash rate. That's not hard at the moment. That's a 3.25% return. But over the last 100 years, the cash rate in Australia has been 5%. In the past 40 years, it's been 7%. So this portfolio is designed to do whatever cash does, plus a margin of 3. And you can see that it's got quite a lot of defensive assets in it. We go to balanced, cash plus 4, and growth, cash plus 5. So these portfolios won't do these returns every year, every month, every quarter. It would be great if they did, make our job easier. But over the medium to longer term, so 5 to 7 year time horizons, about 90% of the time, they're going to reach or exceed that return. So that's the kind of roadmap that we're using to advise clients around their investment policy. And really importantly right now, you need to have 45% of your growth assets in Aussie shares. You need to have 16 in international shares, another 16 in small caps, and about 20% in liquid alternatives. So a lot of people who are just sitting on their hands, their share values were falling and they weren't reweighting back into them because they're going, oh, I'm not going to put more money into that, it's falling. And then right at the bottom, they're underinvested. So instead of having 45% of their portfolio in shares, they might have 35% or even less. So when the market bounces, they don't bounce as far. So you need to be rebalancing back to that target. Now, it's very, very difficult for someone at home to do this. So that's why we've set up these portfolios where we actually do that for you. So you sit with your advisor, with Jonathan and Craig, you work out your investment policy for your super fund or your family trust or whatever investment structure you're using. You say, look, I like the balanced portfolio, that makes sense to me. And then we go away and pick the companies that we invest in, the managers that we use. But really important in times like this, we rebalance back to that target. So we make sure that you're invested at the low and you're not over-invested at the top of the market. And that's been quite successful. We're still at a pretty bumpy ride. Like March was very difficult. The market was down between 20 and 25%, depending on which index you looked at. So it was kind of hard in March, but we're just making sure that we're sticking to that long-term policy. I've probably been talking for about 15 minutes. So what I might do is just throw it open to questions.
Yeah, thanks for that, Martin. Very informative. Before we go to everybody else's, I've got a few that were pre-supplied to us. I'll just run through a couple of them. Which sector is most likely to bounce back the fastest after the pandemic? Or maybe sectors in your opinion?
Yeah, that's a really good question. I mean, if you would have asked me a few weeks ago, I probably would have said energy, because energy got hit by not just the demand side with the coronavirus lockdowns. It's obviously impacted aviation the most and motor vehicle traffic and also even seaborne cargo traffic. So they're the three big users of energy. They've all been smashed, but it's also been hit with this supply side issue where the Saudis through OPEC tried to convince Russia to also cut back production, and Russia said no. So the Saudis created a price war. So there's now so much oil around, there's no place to store it. So energy is going to have a lot of problems to work through. So if I rule out energy, I still think energy is going to bounce, but it's going to be messy. The people that probably have been hit the hardest will be the ones that recover fastest. So if you think about the economy itself, what's shut down completely, as I said, any sort of travel and people going to work, driving to work. So things like airports, air travel will recover. It'll recover slowly, but it'll recover, and you'll get back to normal in probably 18 months to 2 years. So I think things like Auckland, Sydney Airport, these sorts of companies are worth looking at. What will recover quicker will be road traffic. So road traffic's down about 70%, 80% in most cities. So again, the toll roads like Transurban's halved in value, right? Atlas Satira is the French toll road. That's halved in value. So those companies are probably going to recover quite rapidly. And the other one is just, things like, mining services and contracting and those sorts of things. Will capital expenditure in the mining industry pick back up again? That's probably going to take a little bit longer. So I think the thing we're trying to do, Jonathan, and to the person who asked the question, is that in times like this, you get quality companies at a discount. So, I remember 87 crash. I was a youngster back then, but I remember everyone bought quality stocks. GFC, the quality stocks came out of that a lot faster. So, good balance sheets, good management, good businesses, the CSLs of the world, they perform well, but they're going to continue to perform well. So Wesfarmers, some of these really well-managed, good balance sheet companies will continue to do well. So the sell down's not just necessarily an opportunity to buy the thing that's going to whipsaw back up. It's also an opportunity to improve the quality of your portfolio without having to pay the big multiples that you used to have to.
And you use it, and there's a follow-on. I'm just going to extrapolate from the question. China went through this first, along with South Korea, and we've seen a number of their GDP starting to come back up, along with the manufacturing index. They're along the line. Which other countries do you think, again, that have been hit the hardest, that are going to see the real snapback as well?
Actually, Australia looks incredibly good. So the data in Australia is, and again, you probably see this on the news every night, but we've had a maximum like 6,500 people get infected out of a population of 24 million. And look, 11 million people travel overseas every year. So it's not like we're a small closed economy like China, or big closed economy like China. We got lots of touch points. So we're getting down to single digit, numbers. So I think Australia can open up and get back to work. And so I think a lot of domestic businesses, I think, will bounce back pretty hard. But outside of that, in terms of countries that look like they've nailed this, Switzerland, Germany, they stand out as having active case counts coming down. Again, they've got a lot of borders, so they need to worry about the countries around them as well. But it does look like Italy, France to a lesser extent, definitely Germany and Spain to a lesser extent, and Switzerland look like they've got this under control. So they'll probably be the quickest ones to open.
Okay, thanks for that. The other questions were all very much on a personal nature, so we would need to run through that at a more personal advice level. So you can always contact us afterwards and we can have a private chat. I might now throw it open if anybody else has a question they'd like to ask.
My name is Crabb. Just wondering, thanks for the chat. Are you seeing anything in commercial property? Do you think that will be a bounce back quickly?
Yeah, it's a bit of an interesting one, Crombie. There hasn't really been too many transactions in the commercial property space for people to get their head around. We had a guy from CBRE in our office last week just having a bit of a chat to us about it. I suppose there's a little bit of caution and nervousness amongst the real estate community about who goes first. There was a building sold by Flight Centre, their head office down in St Kilda. They sold that. They put it on the market for 60 mil and they sold it for 60 mil. So that was, I suppose, good, but it was a small transaction. So I think it's one of these things where it's this illiquid market versus liquid market. We can see the liquid market has sold off 35% and bounced back 15%. The commercial market hasn't really traded. So there's a little bit of concern about that. So I would not be wanting to try and sell an office block in the CBD right now because it's empty. And yes, most of the tenants can pay. Like this building here, we've got Morgan Stanley, UBS, Pendle, the old BT. They're all in this building. There's no one here. They're all at home, but they can pay their rents. But some of maybe the second or third tier office buildings in the city, maybe some of those tenants will struggle to pay the rent. So I wouldn't want to be selling an office building or a shopping mall for that reason in this sort of market. So I think there'll probably be somewhere, Crombie, a distressed seller. You'll just have to move it because they've got a debt to pay or something like that. So you might get one or two crazy sales, but I think most people will view that this is a 1 or 2 quarter phenomenon. And so unless you have to sell your property, you're probably just going to have to ride a bit of a valuation hit. We're hearing sort of 8 to 10% valuation hits on some assets. I think the Reserve Bank governor yesterday thought house prices might be down 9 or 10% this year. So I don't know where they come up with these numbers, but they obviously do some work. So I would have thought, 8 to 10% downdraft on valuations is kind of what's been bounding around at the moment.
Yeah. I mean, I'm in commercial property, but I'm acting for tenants. So I'm finding, particularly on the retail side, they're all getting reductions. And a lot of them are closed. If you go to Warringah Mall, it's completely closed, but there are only pretty half a dozen tenants open. So they are doing it tough. People are going online. And then on commercial, I'm acting for smaller tenants, trying to get rent abatements, maybe pushing out the end of the lease instead. And but yeah, people are, there's hardly anybody in the office, I don't think. Everyone's at home. So tough market.
Yeah, it is. And I think, I haven't heard of too many people being not accommodating. So, whether it's a bank, most of the bank's websites, when you log on, they say, oh, you're having problems with COVID-19 issues, get in contact with us. We'll give you 6 months, up to 6 months, holiday on both your interest and your repayments. So they're being encouraged by the government and the Reserve Bank to do that. And that obviously then flows through to landlords. Landlords are being encouraged to negotiate with their tenants, whether it's residential or commercial. So, hopefully we can all work through this. It's this concept of we're all in this together. But there's probably going to be some people that are trying to be a little bit more aggressive with their tenants or their customers, and they probably won't come out of this as well as some of the others will.
Yeah. Thanks, great. That's great. Thank you very much.
Thank you. Probably have time for one or two more questions. Anybody else online?
I've actually got one, Jonathan and Martin, just on the debt side of things with government debt. And, we're all very, I guess we're relieved that the government stepped in and certainly helping out small business and a number of people who've lost their jobs. But if you look long-term, Martin, and put your economic hat on for a sec, what do you see long-term from all this stimulus? I mean, how does the government get back? I mean, they're not going back to a surplus anytime soon, but are we looking at, in years to come, are we looking at higher taxes or, what do you see from a political landscape 5 or 10 years from now to get some of this money back that they're handing out?
Yeah, no, you're spot on. And I have to congratulate you on how smartly dressed you are today too, Craig. You seem to be wearing a tie.
Only bloke wearing a tie in his house.
Look, you're spot on. Aussie government's going to take on 120, 150, $200 billion worth of debt to make these stimulus measures in the economy, which, as Governor Lowe said yesterday, is absolutely the right thing to do. And he was asked about, paying it off. He said, well, interest rates are very low, so you don't have to worry about it. So, well, that's kind of crazy, right? We do have to pay off that debt at some point. We can't just taking on unlimited amounts of debt. Even if they manipulate interest rates to kind of zero, which is where they are now, that is going to be. I mean, the whole idea of debt is that the future generations have to pay it off. So we're going to go from being a relatively undergeared country to being, overgeared. Now, the fact that everyone else is overgeared is irrelevant. We still have to pay off that debt. So you've got to look at the government outlays and income. Income is corporate tax, income tax, all those sort of stamp duties and all those sorts of things at a national level. Either they go up or spending needs to go down at some point. So I would think it's very difficult for the government to cut spending too much, given I think all voters will want more money spent on healthcare now. Bill Gates talks about it really intelligently. He said, look, after the two world wars, the peoples of the world demanded an armed force, a properly funded, trained armed force to deal with these issues going forward. So that created this military complex that became a significant part of the world economy. Now they're going to do the same with viruses, with healthcare workers. We want a standing army of highly trained, well-equipped medical professionals to deal with these things in the future. That's going to cost money. Government's going to have to do that. So I can't see it being on the spending side, Craig. So it's going to have to be on the revenue side. So I think we're going to have higher taxes. I mean, we've all got to pay for this somehow. You would think that income tax cuts have got to be off the table. Talk about corporate tax cuts got to be off the table. And I think you have to see those things going up over time, because basically we've got to pay for this. We also have a much larger welfare state now. I mean, yes, some of it's temporary, but some of the people who've lost their jobs won't get them back. So I think we're going to have to carry probably a greater number of unemployed, a greater healthcare burden, and we have to pay higher taxes in the future. I think that's inevitable.
Thanks for that. Thank you.
All right, thanks, Martin. I think with that, we might draw this to a close. We should be able to get this recording up, and that should go up on the Warringah website, I believe, Matt. And if anyone else requires or wants a chat or wants a copy of the presentation or any more information on the portfolios that Martin was talking about, please reach out to either Craig or myself. And I think given this, we'll look to do one of these maybe in the next couple of months to keep an update. So once again, thank you for attending, and we look forward to chatting to you soon.
Thanks very much.